In this video, we're going to talk about what are capital gains. We hear this phrase all the time, capital gains. Sometimes lawmakers will talk about increasing or even eliminating the capital gains tax. What are capital gains, and does this apply to ordinary people, or is this just for the truly, really, very wealthy? So I wanted to explain a capital gain is just profits that you earn from selling an asset that has increased in value since the time you purchased it. So let's use real estate as an example. You bought your house, 20 years ago, and it was $200,000. You sell your house today, and it sells for $700,000. Your basis, which is a topic of another video that you can watch on my channel here, but your basis in that would be your investment in the house. So in this case, $200,000, and the house sells for 700, and so there would be a profit of 500,000, $500,000. And so in this example, you would pay what are called long-term capital gains on that $500,000 profit. What's the difference between long-term capital gain and short-term capital gain? So a long-term capital gain is an asset that's held for more than a year. So a year and a day or more qualifies for long-term capital gain, income tax treatment, and it's advantageous over short-term capital gains. Well, what are short-term capital gains? Short-term capital gains are assets that are held for less than a year or less, technically, and they're subject to ordinary tax rates. What does that mean? Well, that means if you're a high income earner and you have short-term capital gains, then you're going to pay the taxes on those short-term gains at your ordinary, whatever your highest tax bracket is at that point in time. So if you're at the 38% bracket, that would be very disadvantageous. Long-term capital gains. Well, what's the difference between holding this asset for a year or a year and a day or more versus short-term capital gains? Well, long-term capital gains actually have three different tax brackets. One is 0%, the middle rate is 15%, the upper rate is only 20%. So you can see there the difference between long-term and short-term capital gains is pretty significant, or can be pretty significant. Recently, I had a case where the client's overall income was so low that we got it converted from, the IRS was indicating it was a short-term capital gain. In fact, it was a long-term capital gain, and we were able to prove that. Not only that, they fell in that 0% bracket. So we really saved them a tremendous amount of money. So these are things that you need to learn and that you need to know if you're going to dabble in the stock market, cryptocurrency, real estate, collectibles, gold, gold and silver and other precious metals, collectibles like antiques and paintings, art. All these things have a basis, and all these things are going to be taxed as capital gains if you sell them at a profit. If you sell them at a loss, you can actually take advantage of the losses, but they can only offset gains taken in that year in that same category. What am I talking about? Well, if you have a short-term capital loss, you can offset any short-term capital gains in that particular year. Long-term capital gains, if you have a long-term capital loss, the general rule for the stock market is you can only offset that at $3,000 per year. Pretty crummy deal if you ask me, but I guess that's the way that Congress makes sure that you don't just play in the stock market so much that you don't care if you lose. Hopefully this video helps somebody out there, and if you have an interest in these types of videos, you can visit our website at getirshelp.com.